If you're an investor, founder, or business owner, you probably already have money working somewhere: stocks, real estate, or a business generating you income. But here's the problem most high earners eventually run into: your capital isn't keeping pace with how hard you work. You build something, you earn it, and how the money you save it sitting in vehicles returning 5, 6, maybe 8% a year, while somewhere in the back of your mind, you know there is a better way to deploy it. Hey everyone, my name is Emilio. Over the past 6 years, I have installed an automated trading system to over 300 clients, entrepreneurs, investors, founders, people who had the capital and wanted to work way harder without adding another thing to manage. Today, I'm sharing the 3 criteria on how I use to evaluate any investment, not just mine, but any. And by the end of this video, you'll have a full framework you can apply to every capital decision you make from here moving forward. First, what is the return relative to the time it actually costs you? Most investors track one number: the return percentage. They will often say, "My portfolio made 9% this year," and feel good about it. They will never run the second calculation: how many hours did I spend managing that? I used to own a rental property. On paper, it made sense. Real estate, safe, proven, it built equity over time. But here's actually what happened. The cash flow after mortgage, maintenance, and managing fees was almost nothing. And the time it required, I was dealing with something almost every month: a repair, a dispute, chasing down statements, phone calls I didn't want to take. So one night, I sat down and ran the actual math. What was I earning per hour of time I invested in this property? The number was so embarrassing. I was generating less per hour from this investment that I earned doing basically anything else with my time. So I sold the real estate and moved on. That experience made it clear to me: return percentage is only half of the equation. The real number is return per hour of time invested in managing that investment. For example, if you're a founder, your time is worth probably thousands of dollars per hour. An investment that earns you, say, 12% annually, but requires 15 hours of your time per month, has a hidden cost most people never calculate. You're not just measuring what you made, you're measuring what you gave up to make it. The system that I run now takes roughly 20 minutes a month. It operates 24/7. While I'm in meetings, traveling, sleeping, it runs fully hands-off and I don't have to deal with it. So the point is, before you evaluate any investment, ask, what is it actually cost in time? Your hours also have a price and you need to take them into consideration. Point number 2, does it require you to predict the market? Before I built this system, I spent years trading manually. And here's the thing I eventually had to accept. And I have since confirmed this across hundreds of clients who came to me after the same experience. Being smart, doing the research, being analytical, none of it solves the core problem, because markets don't move based on your thesis. The pattern that I kept seeing in myself and pretty much everyone I talked to, it was the same. You identify a position, you build conviction, and then finally enter a trade. The market moves against you and you panic. Not because your analysis was wrong. Sometimes what you did before entering the trade was completely right. But markets move on flows, sentiment, and global events. So inputs that no individual investor can consistently predict. So what do? You hold in your position because you're sure of your analysis. It keeps going against your way. You close it at a worst possible time, not from one big disaster, from a slow, consistent bleed that adds up to a real money over months. But here's the insight that changed my approach forever. I stopped asking myself, how do I figure out where the market goes? And started asking, how do I build something that makes me money regardless of where it goes? And in volatile markets, that question has an answer, because these markets move every single day. It doesn't matter which direction, they just move. And that movement is fuel when you have the right system. For example, this trading bot that I set up over a month ago has generated over 30% in cash flow without predicting where the price is gonna go, and without investing a single minute after I set it up. The difference isn't better prediction, it's that it doesn't need to predict direction at all. It just needs the asset to be active and go up and down in value, which is going to happen anyway. And I will be transparent about the full range. most months land between 5 to 10%. My best month has been 17% so far. In fact, in 2025, the best month I had was 12%. And I have had months that negative as well, like 3% or 4%. Anyone showing you a straight line up with no bad months honestly has something to hide. So does this investment require you to predict the future, or does it generate returns regardless of the direction? Because I spent years trying to outthink the market, building something that doesn't require that, and it turned out way better than what I expected. And point number 3, and should be actually the first thing you ask yourself, is what's the actual downside? Here's why. When a strategy loses badly, it just doesn't cost you money. It costs you confidence. And lost confidence is almost always way more expensive than the actual loss itself. I have talked to investors who deployed capital into leverage positions, watched it get wiped out in a single market move, and then sat completely on the sidelines for over years with so much fear of taking action again. I get it, the capital loss was painful, but the frozen inaction that followed while the market recovered, that's where the real damage happened. One bad trade didn't just cost them the position, it cost them everything they would have made in the 12 months after. So every design decision in my system started with protection, not even the return itself. Protection is key, because that protection will bring consistency, and that consistency brings way more growth than if you make a huge month and then lose it all the next one. So yeah guys, those are the 3 things I always consider before investing in something, and it's honestly what I built my system around. Now, if you're an investor, entrepreneur, or founder and want to get the same, if not better returns on the market, then there is a link in the description where you can book a call and we can see how we could potentially help you out. If not, that's totally fine. I hope you got value out of this video, which is honestly the most important thing for me. That being said, guys, thank you so much for watching. God bless you. Make sure to subscribe, and I'll see you on the next one. Peace.